Hello, everyone. Thank you so much for joining us yet again on your Mortgage Minute Monday with the Linda May Tomko, home financing advisor with Scotia Bank. Who am I? Well, I'm Alex Ward, your favorite broker owner of Maxwell Devonshire Realty. And today, Linda May is going to be chatting with us about the difference between an insured mortgage and a conventional mortgage, and why on an insured mortgage, you actually get a better interest rate, but on a conventional mortgage, you have a higher opportunity to do some flexibility and probably actually an easier approval process. Linda May, the floor is yours.
Hello, everyone. Hope everyone had a great weekend. Happy Monday. So I've had a lot of questions lately about the difference between an insured mortgage and, well, people don't know that it's actually called conventional, but what it is 20% down. So when you're putting 20% down on a purchase, it's considered a conventional mortgage. If you're doing any sort of refinancing, like pulling any equity out of your home, you have to do it as conventional. So you have to have 20% in equity in the home in order to do that. There is another type or an option, I guess we'll call it, in the mortgage world right now, because we have so many people coming up for renewals. We have what's called switches. So that would be moving your insured mortgage over, say, to another lender. And so that would get you a rate, like an insured rate, because there is two different rates. So insured rates and conventional rates. The insured rate is actually a cheaper, well, a better interest rate than a conventional rate. And the reason being is because the bank actually insures the mortgage. And we end up having, having insurance on the mortgage. So if there is a default on it, the bank actually is covered. So that's why the insured mortgages are a cheaper interest rate, because it technically is less risk to the bank. So we can offer a better interest rate on it. With that said, you do pay a premium upfront in order to have the insured mortgages. But when you're switching the mortgage from another lender to a new lender at renewal time, you don't have to repay that insurance. So you can get the interest rate of an insured mortgage at a new lender if you switch it. Now, some of the, I guess, the reasons people don't do this option is because you do have to stay with your original amortization. So you can't make any changes to the amortization, and you have to pay out the mortgage exactly as what it is. So you can't say you needed $40,000 to pay out some debt. That's not an option when you're switching it as is to another lender and keeping your current insured mortgage rate. When you're doing a conventional mortgage, you have more flexibility. So you can take your amortization up to 30 years or 25 years or whatever amortization you would like. But you do pay conventional interest rates in order to do that. Now, the difference between them is not huge. Like right now, the difference between them is about 25 to 35 basis points, depending on the lender. But I mean, that is a huge saving. So if you do have the option of bringing it over as a switch and you're just strictly looking at keeping everything the same with it, that would be the best option, because you do get a better rate.
And what are the most common insurers?
Well, there's only 3 insurers in Canada. So there is Sagen, Canada Guarantee, and CMHC. I guess every lender kind of has their most common one that they use. We use a blend of all 3. So, and when you're moving a mortgage as is, so when you're moving it over as a switch, you have to stay with your current insurer. You cannot move insurers. So if your current mortgage is with CMHC, it has to move over to the lender as CMHC. So that's one thing that can kind of be tricky, is to know which insurer you're with, but we can make a call. So we would just call the insurers and verify which one it's with, and then we would get the policy reference number at the time, and we would move that over as is.
Yeah, and you mentioned there was some more flexibility if you went with the conventional. What would some of those flexibilities be?
So flexibility on that is basically you can take it up to a 30-year amortization. So it's going to decrease the payments. You do not have that option with an insured. Max is 25 years. And with a switch, your max amortization is what your original amortization was.
Yeah, so basically it helps you approve for more if you're able to do more down. Not only will your mortgage be less if you're purchasing the same property, but you can also amortize it out more, so then your payment is lower, therefore making your qualifications that much simpler.
100%. Yeah.
Yeah. Now, you had said some equity takeouts or refinances. Are there any examples where you can still do an equity takeout or a finance if you are in an insured product? Let's say like through a separation?
Oh, yeah. So if you are separating, and actually you can do it if, say, you're being bought out of a property. So it's actually not limited only to separations, but for example, separation from a spouse, as long as the separation agreement shows that there's a payout in the like a split of equity, then you can actually include that in in we don't call it a refinance, but we call it a like an equity takeout basically, and we can pull it right up to 95% loan to value again in order to pay out the spouse.
So 50% of you out there, this is probably good information to know,
Right?
just
Yeah.
statistically speaking.
Yeah,
So
the after COVID marital breakdowns are still coming down the pipe. So
yeah,
unfortunately.
yeah, yeah. Um, yeah, well, that's wonderful. So what what's your recommendation when you have someone that has the 20% down versus someone or they're like, hey, I might want that cheaper interest rate. How do you make that recommendation? Obviously, knowing that each situation is individual, but
Yeah, I mean, obviously, if they have the 20% down, conventional is always still a great option because you don't pay the premiums, right? But if they have, say they're wanting to do renovations or they have other expenses coming up in the future, then I'm going to recommend save your money, go the insured route. Because our rates, overall in Canada are still great rates. Historically, we're not terrible, right? So the difference between even conventional and insured right now, the rates are 0.35%. So it saves you the insurance premium if you go conventional. If you go insured, you're going to get a slightly better rate. So it depends on where the fit is. Now, if we're talking switches, say they're wanting to renew and they're coming over to a new lender, we're going to look at both options. Do they have debt payout? Does the deal qualify? So if we move it over as a switch, does it actually qualify? Because we now say they had a 15-year amortization. We now have to qualify that application at 15 years, right? So we have to, show that we can do that. So if they can't, then going conventional is probably the best option on that end.
it's funny. Still insured, but you still have to requalify as if it's a brand new mortgage. Anyways,
Well,
that's Canadian
yeah. So
banking
this
for you.
is,
Anyways, moving on because we won't fall down that rabbit hole. Moving on, just
yeah.
a little bit of hilarity. Can you explain kind of how the insurance premium works for those that don't know what an insured mortgage is?
So insurance premium, if you're doing 5% down, it's 4% of purchase price, and then the premiums go down from there.
Which would mean you actually only have 1% of equity within the home once you buy it. Just
100%.
so
Yeah.
all of you are aware,
Yeah.
it gets added to your mortgage. So therefore, you're buying a $100,000 place, you had 5K down, your mortgage now is $99,000.
Right. Now in Alberta, with property values increasing, this is less of a concern because you're buying at a low market right now. Anyways, who's to say what you're going to be buying at in 6 months? But that's a little bit less of a concern. If you're buying in a market that may be in a declining or it doesn't look like it's going to be increasing anytime, you may not have a lot of equity in your home for a long time if you're buying insured.
Yeah.
So,
Or for all of you that bought in late 2007, you know the joys of thinking
yes,
you're buying in a good market and then finding out
right.
real quick that it's not that great. But
But you and I both know that buying either way, whether it's insured conventionally, is still better than renting. So, right? At least there's options.
that was Linda May Tomko, home financing advisor with Scotia Bank. I'm Alex Ward, your broker owner of Maxwell Devonshire Realty. We were just educating you on the difference between conventional and insured and the risks and benefits of both. Stay tuned. Make sure you hit that like and subscribe button and follow us for more content next week. See you, everyone.
Thanks.